Good day, fellow investors. I get the question very often, Sven, what do you think about dividends? Should we be a dividend-focused investor, focusing on growth, or focusing on who knows what? In this video, I really want to go through the historical impact on dividends over time to give you a better picture whether you should think about dividends in your portfolio or not. This was a really great comment from Ignacio. He asks, Sven, what should be the dividend yield for a portfolio sustainable over the long term that I should focus to? 1.5, 6% is, let's say, the possibility, but what to focus on? And then I say, I have actually a nice dividend portfolio because that's where I found value over time, and the dividend on cost on the portfolio I started in 2019 is likely above 10% or higher now, which allows me to do compounding. So let's start with dividends and returns. There are three ways a company can distribute the earnings it makes and give you value. It can pay a dividend, of course, it can do buybacks, or it can reinvest earnings. When it comes to reinvesting, it depends on the possibility of returns on reinvested capital. When it comes to buybacks, the value created for you depends on the price that the company is doing buybacks, and on the dividends it also depends on whether it's better to reinvest, not, and of course on the taxes. If you have the unfortunate truth of being an investor in Denmark or in Canada with 50% dividend taxes, I'm really sorry for you, but then you have probably other benefits, and you have to always balance that to see, okay, this is my taxes, put it in your own personal valuation, and then see what is best, whether to focus on buybacks, earnings, of course, always talking about great businesses. Of course, you have to see that, and then always ask yourself, okay, how is the business creating value for me as an investor, as an owner of that business? See how are you structuring your portfolio, what are your financial goals. So let's discuss dividends in depth to give you an answer and see whether dividends and dividend-focused investments might be your answer. Historical performance on dividends. This is an article I really like from Professor Macquarie. So stock market charts you never saw, and you never saw these charts, and it's very important to see that for perspective. This is the normal chart, everyone knows it. Stocks go constantly up and up, and those went even higher from 2005, so up and up. But this chart you don't see that often. So from 1919 till 1949, 30 years, stocks went nowhere. So that's also something that can happen, and that happens if we deduct the inflation from the total return here, total return chart that you are so accustomed to, then you see that, oops, stocks are not really, just in general stocks, such a great driver of returns. And if we focus here on the bottom, during the 1852 to 1932 period, inflation was intermittent with long spells of deflation before they created the Fed, and dividends accounted for almost all of total returns. So dividends was core before the Fed invented the printing machine, and that's something we have to know, because this chart is because the Fed invented the printing machine and inflation. Just a note here, I'm going to start to make really less and less videos. I'll try to focus on making quality videos at the last weekend of the month. So please subscribe and smash that notification bell so that you get notified on the last weekend of the month when I make new videos. I'll do my best to really work hard during the month, do research, and then deliver real value for you. I'm a little bit tired from playing the YouTube game, chasing, filming at 6 in the morning because YouTube needs consistency or something like that. I'm going to put value, and I have enough. If I make more, good. If I make less, also great. So subscribe, smash that notification bell. And if we look at returns, an investor who bought near the top of the 1920s bull market, reinvested the dividends, grew an initial 10,000 investment to about 9.3 million up till 2007, 8, 9. So now that 9 million 2009 bust would be, let's say, 50 million. So 10,000 into 50 million, you would say that's really something amazing. But if we look at the bottom part here and first we calculate 50 million on 10,000, that's 5,000 times your money in 100 years. That's not much than 8.8% per year in total returns. But if we dig deeper and we see that if we adjust for dividends, and let's say you are retired, you spend those dividends, then the same 10,000 and inflation produced a little bit more than 33,000 in real final wealth. The 300-fold difference captures the effect of omitting dividends and adjusting for inflation. Put another way, since 1928, dividends plus inflation accounted for 99.7% of the nominal wealth produced as of 2008. Now we had the biggest stock market boom in history, so this should probably be 99%. So my strategy is, okay, I'm not against dividends, and especially I get those dividends as something that comes along. I'm not afraid of buying dividend stocks, but if I can find dividends and then growth on those dividends, then I have both. If the markets don't react or if the cycle doesn't pick up, I still get those dividends, and that is what I'm happy with. But if the cycle turns, commodity prices went up, and those dividends double, triple, then also what usually happens is my stock doubles and triples. So yes, I'm looking at business growth, dividends, especially dividend growth over time. And also when it comes to dividends, dividends are the confirmation that the business is a cash flow machine. At the end, intrinsic value is the present value of the cash flows the business will distribute from today till Judgment Day. So distribution of cash flows is a sign, okay, this business is really doing well. Without debt levels going higher, like many companies are doing buybacks now, but increasing the debt level, that has no long-term value creation. And of course, now you say Berkshire doesn't pay a dividend. The Berkshire system is based on float, the money coming from insurance, reinvesting that money into businesses that pay dividends. Berkshire bought Burlington Northern Santa Fe, paid, and in 2017 they already pulled out the money they put in through dividends. So Berkshire is also a dividend machine. The just difference is that Berkshire reinvests those earnings so that you can enjoy your life, spend time with family. Warren Buffett takes care of that. That's a big difference also to see how things are reinvested. And one of the key advantages I have and what I focus is not looking at dividends now. Look for dividends 2-3 years from now, because the market is focused on the next quarter, 2 quarters, maximally a year. But if you can find, okay, this mine will be active in 1-2 years, there are no financial issues, they will make that much money. Only when the market recognizes that, you will have dividends, but also the stock price going much higher. And those are one of, we discussed it in another video, hyperbolic discounting when we discuss value investing. Check that video out. And those are one of the most beneficial ways for us retail investors to really do good investing. So, see how dividends fit you. Thanks for watching, subscribe, click that notification bell, and I'll see you in the next video.